So today we are going to discuss about options. Okay, so we are going to learn how options actually work and what are the different kinds of options we have. Okay, to trade in stock market. Okay, so first let us understand what is an options. See, option is a derivative contracts which has an expiry. Okay, you can trade for consecutively, weekly, monthly, or maybe quarterly or yearly sometimes. Okay, so, but before that, we need to understand what is actually the options is. For an example, an underlying asset, it can be a stock, okay, it can be a stock, can be index, maybe currency or commodity. So, whichever having future contracts, all are having option contracts too, almost. Okay, so in terms of trading in options, you should uh, check that which underlying asset has a higher liquidity, because if you are trading in options, there is an expiry and there may be a liquidity issue. Okay, so what is the preferable things? The stocks index, this is a preferable thing to trade in options. Okay, so as we already told that the options will be derived from the underlying asset, maybe stock or index. So now every stock doesn't have any future and option segment. Okay, some particular listed company, almost 190 stocks in NSE that are traded in option and future. And index, there are almost four index in NSE, like Nifty, Bank Nifty, Fin Nifty, and Nifty Mid Cap. That four indices we are having currently, which are trading in future and options. Okay, so let's check how that option actually work. Okay, so the option will be having some premium. Okay, that premium will be derived from the stock or index, that is the underlying asset. Okay, so if the price moving, so the option price will also move, okay, with a particular proportion of amount. So how it will work? For an example, we have a stock called SBI. Okay, so there are three conditions in any stock. Okay, three conditions in the sense, the movement of the price, either it can go higher from the previous high, it can go higher, it can consolidate, or it can go down. There are the three conditions a stock price move like. For an example, a stock price of SBI is trading around 590. At a particular time, it can remain at 590 level. It can go above 600 or it can go below 590. It may come to 580 rupees. Okay. So what is the benefit of doing option trading, or what is the purpose? See, suppose the people who are having SBI share, they have purchased the full capital share, maybe 5 5,000 quantity. They have bought in cash market. Okay, the 5,000 shares. But the thing is, for an example, a person who bought 5,000 quantity worth of share, okay, in SBI at the price of 400 rupees. 400 rupees. So what is the value? 5,000 into 4, that is 20 lakh. Okay, 20 lakh worth of SBI share a person bought at some point of time when the price of SBI share was 400 rupees. So now the price of the share, it moved up to 590 rupees. 590 rupees is the current market price of SBI share. Okay, so now the person who is having 20 lakh worth of SBI share. Okay, so now he is expecting that the SBI price, due to some market condition or maybe some newses, they are expecting that SBI share price is going to come down. Okay, whatever, maybe he is expecting, for an example, 20% down. But the thing is, as he is a long-term investor, he don't want to sell his share, because in a short term it can fall 20%, but in a longer term it can give multiple times of return. So he might not get the 400 rupees price in a future time. That is expected. For example, if it is coming down by 20% also, so what is the value? If you calculate, current market price is 590 rupees. If it is come down by 20% also, so that is 118 rupees, correct? So if you calculate it from here 108 rupees, so what will be the value he is expecting? When that means the drop of the price. That is the price. That is 472, not 372. So that is the price. But this price still it is higher than that. Correct? So the condition is this particular person who is expecting that the SBI price is going to fall by 20% from the current market price, that is 590 rupees. So he is expecting the price will fall 470 rupees, 470 rupees. Okay, that is a 20% fall he is expecting with a time span of, for an example, 1 month. He is expecting that the share price of the SBI will fall down by 20% by this month. Okay, but he is not ready to sell his share. Why? Because he may not get that 400 rupees. For an example, he bought the 400 rupees 5000 quantity share. Now the current market price is 590 rupees and he is expecting that the price will fall, but his view may go wrong, correct? So if he sold this particular share 5000 shares at 590 rupees, and if it is moving higher by, for an example, it moving higher instead of going down, maybe 440 or whatever level, so he will lose the amount, correct? Along with that, he will lose the dividend. He will also lose the dividend amount. So he doesn't want that. What he is actually expressing? He is expecting that the price will fall, but he is also expecting not to lose whatever he have gained. For an example, in the current market price, whatever profit he is gaining, he is not expecting that I should lose. So what he can do, instead of buying, instead of selling this SBI share, he has two options. Either he can short SBI future, he can short in SBI future worth of 5000 quantity at the current price. Okay, but to sort that he need a good amount. For an example, 5000 quantity, if you want to sort at maybe for an example, the current market price of the SBI future may be trading at 592. Okay, so if he want to sell the future, okay, so he have to take 5000 quantity. Okay, so he sold 5000 quantity as per the future contract. For an example, it will take 1.4 lakh, 4 lakh per future contract, per contract. Okay, but he might not have that much kind of capital currently, okay, to mitigate that loss. Okay, so what he can do, instead of selling in the future, he can buy a put option expecting that particular fall. Okay, so what he will do, instead of putting that 1.4 lakh rupees worth of future contract, if he has less capital, he can buy put option. Okay, because he is expecting a 20% fall, it is a pretty much good. Okay, so 20% fall is almost 118 rupees. So what he will do, so he has to deal a contract with a particular buyer or seller. Okay, in this case, because all the things are digital, so it will be anonymous. You don't know which person you are buying or which person is selling. Okay, but there will be random, but as you are selling, there will be something buyer, or if you are buying, someone will be selling. Okay, so the thing is, so he will, instead of selling a future contract, he will do he will buy a put option. But in case of put option, or whenever you go to option contract, so you have to decide, or you have to make the contract based on a particular price that is defined by the governing body, that is NSE. Okay, as per the exchange, for a particular price you have to create the contract, and that price will be defined by the stock exchange. For an example, in this case, in the case of SBI banks here, okay, this particular price will be variable from 400 to, for an example, sorry, the current market price is 590. There will be multiple price for which you have to take the contract. Maybe 590, or maybe let's example 590, 580, 560, or in the upper side you can check 600, 610, like that. Okay, so based on that you have to create a contract value with the seller or buyer. Okay, so you have to take the bet as per this predefined price. You can't take a random price. For an example, in between, if exchange has given this particular price to bet on, okay, but you can't take that I am expecting 572 I need to take, because your expectation is 472 is your price, you are expecting that much will fall. Okay, but you can't take a random price to bet on. Okay, because this price may not be given by the buyer or seller. Okay, so you have to create the contract as per the predefined price, and that price is called strike price. Okay, so now as you are expecting the market is going to be fall, so what is your expectation? Expectation is 472, that is your target price, correct? So that is the 20% fall you are expecting from the current market price. 472 is your target price. But see, now you have to create a contract. If the market price come down to 472, you should gain. That is the motto of taking a put option.